Welcome, financial professionals. I'm Brady Serold, Senior Vice President, Disability Income for E4 Insurance Services. Welcome you to The Brew, building relationships every week. Thanks for tuning in. For those joining The Brew for the first time, welcome. We like to start the Brewcast by celebrating today's national days. Today is Talk Like Yoda Day, and no, I'm not even going to try. Today is National Eat More Fruits and Vegetables Day. Now I sound like your mom when you were a kid. You need to eat more fruits and vegetables and stay away from the candy. And then World Fish Migration Day. So we're continuing May's lineup on disability income awareness. I'm welcoming Paul Zimmerman, FALU, FLMI, Vice President and Chief Disability Underwriter at Ameritas Life Insurance Company. He's here to discuss the ins and outs of DI underwriting. Additionally, we'll provide some tips to help you achieve the best possible underwriting decision. Thank you, Paul, for joining us today.
Thanks, Brady. Happy to be here and impart a little wisdom, tips, and tricks that might help everyone underwrite DI and get it through underwriting quickly and efficiently, which is a shared goal we all have.
Exactly. And I'd like to go, I think I met Paul, might have been 2000. I had interviewed and known him for quite a long time, interviewed at it was Union Central at the time, and you were relatively new there. So we've known each other, and, kind of good to get back to my old roots and nerd out on disability underwriting a little bit, because it is a little bit different. Tell us a little bit about yourself, your background, and then, what you most enjoy about disability underwriting.
Yeah, so I have been in underwriting for over 30 years now, which is hard and somewhat sobering to acknowledge. But I started at a small company in Minnesota, which is where I was born and raised, doing both life and disability underwriting. And I moved to Cincinnati to then Union Central to be in a primarily disability underwriting role. Separated from the company for a little bit of time where I was to move to a different carrier in a life underwriting role for about 5 years. And then I came back to what then had become Ameritas in 2008 and have been in this role, DI underwriting role ever since. So never intended to make underwriting a career for me. My education was my career path coming out of college was to be a CPA. And I took the underwriting role not knowing what it was way back when, thinking, well, it's a job and I'll just study for the CPA exam. But I ended up liking it. So here I am decades later, never looked back on the CPA thing. And those times here at the company that I have to interact with CPAs, I'm quite happy I didn't go down the role of becoming an accountant. But no offense to anyone that might be a CPA or an accountant by trade. They're fine people. But I enjoy underwriting. There's a lot about underwriting, which I enjoy, which is why I guess stuck with it for so long. But probably it's a variety. I get to interact with people. In my role currently, it's a lot of home office people. It's a lot of project work, but I still interact with agency managers and producers, and of course, underwriters, our reinsurance partners. And every day kind of brings something new. So anyone that's been an underwriter probably utters the phrase, I thought I'd seen it all. And then here comes something in an application packet, whether it's medical, occupational, or something else that, you have to kind of unravel and deal with. So it can be kind of a trying experience, but I think at the end of the day, that's the kind of thing, for me at least, that keeps me engaged and interested in underwriting as a profession. So, I look at it, I just don't feel like the other accounting, for example, is something that would give me that type of engagement. So for better or worse, here I am 30 plus years later and still enjoying it.
Well, I echo those sentiments. I think it's the one when I was similar to you, small company, life disability underwriter, did some health insurance, and then they kind of shifted, and I had gone to the principal to be a sole DI underwriter, and recruiter had said, oh, you're sealing your career's over. I'm like, oh, that recruiter's off my list. Again, I like you. I thought, life insurance, it's kind of boring. Again, there's a lot of place and purpose, but from an underwriting perspective, you got a manual, there's 26 rate classes, and you can either insure them or it's a certain premium level, right? Disability, you got, medical aspect, which we'll talk about, financial aspect, and then the occupation aspect. Again, over time, occupations have just gotten crazy. So, I think that's the biggest part, is the difference. Like you said, no day is ever the same in the disability underwriting world.
Correct.
So, again, I think, most people have a bad experience with disability, and I think it's because they don't understand it. I would say nobody's going to come to your door as a producer and ever ask for disability insurance. Okay, you might have a resident physician who does it, but if you have a 45-year-old who comes and wants disability insurance, your first question should be, what's wrong? I say that in jest, but it's kind of, most people aren't asking for this sort of product. So, the work is up front in figuring out the right pieces. So, let's start kind of like on the medical aspect. Obviously we have mortality versus morbidity. What do you see from a medical perspective, again, that, is differing? How do you underwrite differently for mortality versus morbidity?
So I would say, so again, in my role here, I do a lot of agent education sessions. Agents new to Ameritas will do meetings with them. And so I deal with a broad spectrum of producers, most of whom are not, too familiar with the disability insurance product, and obviously, therefore, the disability underwriting process. So they are different. And I spend a lot of time, I love to draw contrast between the two, because a lot of the producers that sell our product understand life insurance and the underwriting, and you're exactly correct. Some of those folks, the phrase we hear is, I can never get anything out of DI underwriting, because they're not understanding probably the process. And you hit on it earlier when you're kind of talking about underwriting as a career path. So as a life underwriter, you pretty much have a little bit of financial underwriting to figure out if the face amount is okay. And I am oversimplifying it. I know there's more complex life cases, but a lot of it, the financial underwriting is not that rigorous. And then there's the medical side, and really it's, okay, what tobacco, non-tobacco, and then what rate class, preferred plus, standard, table rating, et cetera. And for DI, product and the process are more complex, but DI underwriters, and why it's more interesting to me, and I'm not putting down my life underwriting colleagues here, but you can look at it one of two ways. We have a lot to be concerned about, and that makes it challenging, but it also gives us a lot of tools that we can use to mitigate risk when we're evaluating someone from a medical standpoint. And the reason I think a lot of people, getting back to, trying to get something out of DI underwriting and having to deliver news that is something is other than applied for, is because of all the variables and the optional riders that DI offers. So again, that's kind of a blessing and a curse, but there's the OC class, elimination periods, benefit periods. We can have exclusion riders. We can have ratings. So there's just a lot there that DI underwriters have to work with, and that there's going to be more cases where something comes out at the end of underwriting differently than was applied. So that you just have to, and it is difficult, yes, and challenging, but it's an important product for people. There's a great need for it. So my message is, don't be dissuaded if things come out on the end of underwriting differently, and you got to overcome that, and that's part of what we're talking about today.
Yeah, so what are some of those common things that, might not kill you, but will disable you that
Yep.
trip people up? I mean, obviously, I think, we'll talk a little bit about mental nervous, probably a little bit about musculoskeletal, because those are probably the two biggest, for lack of words, bugaboos in the disability world. Well, why do you
Correct.
care if I go to a chiropractor?
Yeah.
How do you answer that? Why do you care if they go to a chiropractor?
Yeah. I think to the uninitiated, they think of disability and they're thinking about getting hit by a bus. They're thinking about some dreadful diagnosis like MS or cancer or significant heart disease. But largely, the underwriting guidelines that we have for medical impairments are driven by claims experience. And yeah, cancer is one of our leading causes of disability. There's not a lot we do during the underwriting process. People are going to get cancer. It's just going to happen. If they have a pre-existing condition, we will try to underwrite it. But really, where a lot of the sort of things we see in underwriting are the two hot buttons really are musculoskeletal or orthopedic issues. And then psychiatric or mental nervous is another phrase used in the industry for that stuff. And it's important to keep in mind, most claims don't go beyond 5 years. And a lot of the orthopedic claims, some can turn into a chronic problem, but we have to be concerned as underwriters just, for a claim that could be a year or 2 years. If someone has, some sort of back surgery or whatever. So those, and just a couple examples that people don't, as a producer, I would encourage you to get in the mindset of thinking about what an orthopedic issue could do to an applicant. So if we take me, for example, if I am working in the garage this weekend and cut my index finger off, I'm going to be able to continue to underwrite. But if I'm a dentist, and maybe it's not even as drastic as cutting my finger off, maybe I've fractured it and now have some pins or screws in the finger, that could be a career ender for a dentist using a known occupation definition of disability. If they've lost dexterity in that finger such that they cannot do dental procedures, that person could be disabled permanently from being a dentist. So that's kind of the level of rigor that a DI underwriter has to use and approach with these pre-existing histories. So you got to think, well, what tied into the occupation, and a lot of people don't realize how disabling these orthopedic things can be to certain physicians. And psychiatric claim, mental nervous histories, another hot button. Very prevalent in our society. We underwrite a lot of folks that have anxiety or depression, and I think a lot of folks don't think that would ever get bad enough to cause a disability, but there it is as one of our top 5 causes of disability in our block of business. So we have exclusion riders to deal with that in most cases, but it's also important to remember there is a definite sort of causal relationship between things like depression and how it can exacerbate something like a orthopedic issue. And there are some medical studies. I was at a reinsurance conference recently where they spoke about this, the sort of axis between pain and mental nervous conditions. So if you have depression, basically in a way that can make your back pain worse. And so we could exclude mental nervous conditions, but that person may be more likely to claim for a back problem than someone that doesn't have depression. And of course, you go the other way, someone that has a real chronic back problem or something, that can certainly lead to depression. So there's this axis between chronic pain and mental nervous that can cause or exacerbate disability claims. And that's why you may see an offer, for example, from a disability underwriter, not just an exclusion, but we can't offer guaranteed insurability riders, or we may need to reduce the benefit period to 5 years. It's because of the way certain medical conditions interact with each other, and that can sort of move the risk beyond the mitigation that you get from just a simple exclusion rider.
Right. And that's the one thing, in the mental nervous world and, the psychiatric world is, I think, from my past time, it's, really stability, length of treatment, follow-up information, that can lead to a better outcome. I mean, I would anticipate anybody who is currently being treated or has been recently treated for anxiety or depression will probably at a minimum have an exclusion rider, right?
Correct. I would say, table stakes, as I like to say, for any kind of mental nervous or psychiatric condition is going to be an exclusion rider. And you hit on the exact things disability underwriters are trained to look for. It's not just the diagnosis, that's important. We're going to view someone with a true bipolar disorder differently than situational depression or general anxiety for sure. But beyond that, every case is going to be looked at in terms of, okay, we know the diagnosis. What is the severity? Mild, moderate, severe. Do we have good medical records that document for us the person is compliant with prescribed treatment? Are they going in as their doctor advises for checkups to get medications renewed? We look on script checks. Are the meds being filled consistently? And then within the records, we're also looking to see if the condition is adequately controlled. Red flags an underwriter is going to look for changing of medication. They go from Zoloft to Effexor to some other medication, and the more, or maybe the dosage is increased. It doesn't always mean a real problem, but those are things underwriters are trained to look for and are, I guess I would say, a red flag to say, okay, we need to, maybe this person has a more severe condition, or they're struggling to control it with frontline medications. Those are the things that we're going to look at and say, okay, maybe we can't do increase riders with this case. So those are all things that it's not just the diagnosis. You got to dig deeper.
Yeah, and that would be pretty universal for most conditions, right? I mean,
it is,
and you look at, is it an acute condition that's been resolved? The recency, I know you look at, I'd say somebody who's had back surgery is probably going to have a permanent back exclusion, but somebody who, recently had a back strain, they might have an exclusion or maybe a modified exclusion with, except for trauma, due to lacerations or burns or fractures due to trauma, have extra language on there that, like you said, the person's really worried about, the car accident. What if I break my back? And I always tell people, hey, well, if you're in a car accident bad enough that you broke your back, you probably have more things wrong with you than just your back. But, it's disability insurance is like when you go out and buy a used car. If you have dings and dents in it, are you going to turn those into your insurance after you bought it? Well, no, you can't turn those in. Those existed beforehand. So that's kind of how I frame the exclusion rider.
Yeah. I think on the front end, that's all valid, and it does depend. And we can talk about what we can do in the future. Sometimes we can improve our offer or not, but
how do you do that? I mean, I think that's the part is people will say, well, you put an exclusion rider on there. Why would I take it today? And I say, well, there's so many other things you can be covered for, and the carrier will review it, and they'll say, oh yeah, right, they'll review it. I've had quite a few exclusions removed over time because, again, you got recency to time of application. And, again, are you buying the insurance? You think on the negative side from an insurance carrier, you're protecting the company. You had a back strain 6 months ago and now all of a sudden you want disability insurance. Well, I think, you're looking to go out on claim. I mean, you have to take that stance. But, like you said, at what point, the review, how many do you review and do you actually remove or modify? Obviously if people lose weight and have a sustained over 12 months, I mean, how many cases do you guys look at that you actually do modify and make the contract better?
Yeah, I don't have exact metrics, but it's a lot. Where possible, our underwriters are asked to give advice as to potential for future reconsideration. And it really just depends on the medical history. You touched on a few of them. If someone's had like a spinal fusion surgery, it's probably not, that's a permanent exclusion. The way the underwriter is going to approach it is there a time when this person's risk of claim approaches a standard level or not? So a spine fusion, that person is likely forever at increased risk of, for example, developing spinal arthritis around the fused joint. That's going to be a permanent exclusion. If it's more of a muscular strain, that someone suffered with their neck or back, and there is a reasonable expectation that with time that will heal and there won't be future increased risk. That'd be a great example where we could say after the second policy anniversary, assuming no recurrence, et cetera, we could remove the exclusion. Ratings, kind of a similar thing. It depends on the underlying condition. Obesity is we don't rate. Maybe 3 to 5% of the offers we send out have a rating. It's not that common. Our main tool tends to be exclusion rider, and that can approach 35% of the offers we send out have an exclusion. My advice to a producer is you have to explain to your client disability insurance policies, the nature of them is such that often pre-existing conditions are excluded from coverage. That's just the nature of the beast. So go in eyes open. We exclude a lot of stuff, and you need to set that expectation with your producer. But there are some cases, it depends on the history, whether or not we could maybe remove the exclusion. Ratings are a little trickier. I'll just say, we've had, and you probably had them in your experience as an underwriter, Brady, we'll put a rating on someone for height and weight or something along those lines, and 5 years later they've lost a bunch of weight and they want to be reconsidered. If they've maintained a weight loss for 12 months, yes, we might do that, but you have to remember it is subject to their overall health history when they apply for reconsideration. So some of those, yeah, you lost weight, but that's because your doctor said you just had a heart attack and you need to lose weight if you want to survive. So they do it, they lose the weight. Well, now the problem is you're basically now uninsurable for DI. We're not going to back the rating off because you're actually a worse risk. Even though you've lost weight, you've manifest cardiovascular disease. So it can get a little trickier, I guess, with ratings. But the bottom line is sometimes there is an opportunity to improve a contract after it's been issued.
Yeah, so you go the weight part, and I don't want to go too much into the medical side because I do want to touch on the financial and the occupation piece. But the Mounjaros and Ozempics and trizepatides, what are you seeing with that? Because it's pretty common. People, is it still a wait and see type thing, or how does underwriting view that? I mean, I know the weight loss in the last 12 months, you had half back, but again, if you've maintained the weight loss for more than 12 months and whatever the reason was, and it wasn't because your doctor said you had a heart attack and or you're now a diabetic, which is rated differently. It's just hey, I got too heavy and life got in front of me and now I lost weight and I'm back on track. How do you view that?
Yeah, so that's the GLP-1s, the Ozempics. We get a lot of inquiries on that. It's in the press every other week, it seems like. And right now, our stance, and I believe that of the industry, is we essentially treat that. Well, step one, remember all those drugs were first developed to treat type 2 diabetes. So the first thing an underwriter is going to do is make sure there isn't an underlying glucose issue. And assuming it truly was prescribed just for weight loss, and those now are approved strictly for weight loss, at this time, we're not really doing anything different with that type of weight loss versus someone that's maybe using cognitive therapy as a means to weight loss, or diet and exercise and lifestyle. So it really does come down to, okay, in the last 12 months, how much weight have you lost? We usually add half of that back and then put it into our build chart and go from there. It's a very candidly imprecise system, but we may at some point change our stance on that because people are losing so much weight in a rapid period of time with these drugs that we might have to alter our approach. But basically now we just view it as another tool that an attending physician has to get their patients to bring their weight down into a normal level. And we don't view them any differently than some of the other weight loss drugs that have been out there. The difference is these are so much more effective. But what we really are looking for is get a period of stability before we'll really consider the new lower weight, just as you said.
Okay. I guess there's a couple more on the medical side that I wanted to ask you. can there be too many exclusions? I mean, is there a point where you just can't off? I mean, they're not uninsurable, but they just have so many things.
Yeah.
If you look at them, there's like, okay, there's not one thing that makes them uninsurable, but the combination of things, you just can't make an offer.
Yes, I would kind of say two things. One's a little more nuanced, but on occasion it may just be a single exclusion if whatever the person's problem is or what we're trying to possibly exclude is so fundamental to their ability to perform their occupation. Even a single exclusion may be such that we would say, you know what, it's just too risky, even with an exclusion.
I have one. Like I just had one that was decline, a dentist who had Dupuytren's contracture.
Yeah, I mean this is maybe sounds a little cynical, but yeah, we could exclude the finger for the contracture. But if you go and look at claim files, again, this is not everyone, and it sounds a little trite, but people will find another way to go out on claim on some of those situations, and that's why you'll see a decision like that from time to time. It's not common. More common would be your question, which is, are there too many exclusions? And it's sort of the same underlying philosophy. At Ameritas, we typically say we're okay up to 3 exclusions for various conditions, depending on how they play with each other and the sort of severity of the underlying condition. When we get to 3 exclusions, we might say we're going to limit the benefit period to 5 years with the exclusions, or 3 exclusions, or something along those lines. We will stretch to 4. 5 is probably a bridge too far. So somewhere in there, again, you have to look at what are we excluding? Some exclusions, if they're really tight and not super severe, like maybe someone just had ACL repair surgery, and we're pretty confident that in a year we could remove the exclusion. And people do very well after ACL surgery without a lot of long-term issues. It does not predispose to osteoarthritis. Meniscal surgery does. That might be one where if that's what put us over the 3, we might, say, okay, we'll still play ball. But yeah, there is a point where it's just too much.
Okay.
Too much
But
risk.
again, I think, you look from a medical side, and I think that's the one thing we try to do here at E4 is get as much information up front. I mean, we've developed a guide to getting the best illustration, intake form, asking the questions, because I found, hey, we can work with things if we know it. And I think if somebody understands it up front, the more we know, the more we can work. And, you guys have been a great partner in working, and coming in doing some pre-screens, to say, hey, how might this be? What additional questions might we ask? And I'll throw out like ulcerative colitis or, Crohn's disease, or, again, the different conditions. At what point can you cover what potential rating, at least to be able to go back and have, give your client, it's not a, hey, we're going to submit it and see what happens. It's more than likely you're going to have this exclusion and this exclusion, or this rating, or this might be taken off the policy. So at least, when it comes out of underwriting, it looks like what we told you it might be. And that's because we did the right thing up front, and working with your team. And, you guys have been great to work with, from that perspective. And the last medical piece I'm going to hit on is marijuana. What's your stance on marijuana?
Yeah,
it's as prevalent as psychiatric disorders and musculoskeletal disorders, right?
It's amazing what's happened, with the various regulatory and legal changes in our society over the last 10 years. And it may come to surprise a few people. We're, in my mind, pretty lenient on how we view marijuana use at Ameritas. We don't change someone to tobacco status. We basically are looking at, how frequently they're using the product. And if it reaches a certain threshold, maybe 3 times a week, 4 times a week, we might put a rating on the policy. For our policies, our rating structure really goes 25, 50, 75, 100%. And there does come a point, a daily marijuana user, we're not going to insure. That's getting after it pretty good. But the reality is, and this has been true for quite a while, I think producers may not even be aware of it, but if you if you come to us and you're honest and I use marijuana once a week or whatever, we accept them without any penalty. And that's the vast majority of our applicants.
Okay.
It is just not usually something that's that impactful to underwriting unless they're really, I guess I'll say, overindulging. And as a sidebar, actually medical marijuana use is perhaps a bit more problematic than recreational use, believe it or not. The problem with medical marijuana is that, at least in theory, that means they failed conventional therapy for some sort of significant. We're underwriting the underlying problem, and it can be hard in those cases to get medical records and assess if it's chronic pain or epilepsy or some of these things. That can be a problem. But for the recreational marijuana user, typically not problematic for us.
Okay, awesome. Well, we'll kind of switch gears here.
Sure.
I'm going to go to the occupation side because that's your, again, like you said, if you're a CPA, you're a CPA. There's no, what do you do daily? Kind of, you already know what they do. But what do you kind of look for, from a business owner? What additional information, occupation duties? I guess that's, it's the short snippet of from an occupation standpoint. I know you have you got risky classes to non-risky. What are you looking for from an occupation and information, to get the best piece? Again, we like this, as I would say, I like to paint the picture for the underwriter. I don't like the underwriter painting their own picture of what my client looks like. So what sort of things are you looking for when we, put the job duties? And it's like, I'm president of ABC Sanitation Company. I'm like, okay, that means nothing. That could mean you're waste management and you're making $3 million a year, or that could mean you own a dump truck and you go to people's garages and take their crap out and take it to the dump.
Yeah.
I mean, you're president of your own company. Title's not everything.
That is correct. So those are all great points. And that, the OC class is something we use at point of issue to determine the premium we charge. It should correlate with the risk presented by the applicant's occupation. And this may be one area where, we underwrite a lot of medical market people, physicians and doctors, and they're actually easier to assign an occupation class to. They come the closest to being able to say, what's your job title? And that equals the OC class. But for most other folks, what we see as underwriters is people try and assign an occupation class based on job title, just like the example that you gave us. So we ask the question on our application. We don't often get good granular information, but the most important thing an underwriter wants to know is, what are you doing, Mr. or Miss Applicant, day in and day out in your job? And we're going to look for, is it administrative duties, managerial duties, or are you swinging hammers and turning wrenches or things like that? And yes, sometimes the job title does not equal the actual job duties. So if, I would encourage all producers on the question on the app to, there is listed out. If you're a CEO or whatever, then the expectation is, tell us, I spend my time in an office managing people, working with financial statements and things like that, versus I'm CEO of ABC Plumbing, and the duties are I unclog drains and drive to clients' businesses to fix their plumbing issues. And there are a few other things that the underwriters are trained to look for. And we ask these questions on the app, especially for business owners. Yes, I own 100% of my business. How many employees are in your business? 3. Okay, so if you're a plumber and you're telling me you're the CEO, but you have 3 employees, the underwriter is probably going to say, I think there's a greater chance you're going to be swinging hammers or turning wrenches, so to speak. And you may get a follow-up question from an underwriter saying, can you please confirm or give me an outline of what percent of, on average, weekly time is spent in the field versus sitting in an office and things like that. And that really is what drives the OC class.
Right. So really it comes down to, we talked about even for medical, it's pre-screen. Let's get,
Yeah.
we ask those same questions, on our pre-screen form. Let's get the yacht class right. Because again, in underwriters, because you applied as a 4A, if the underwriter feels it can be a 5A, they'll give you a 5A.
Yeah.
Like, no,
Yeah.
we're able to do it and give you the better yacht class. What you don't want is to show them a 5A quote and then it come back being a 2A.
Yeah.
That's
Now that's a
not a
bad day for
positive,
everyone.
not a positive client
Yeah, and
experience.
you hit it right. Paint the picture for the underwriter. When you think about what we're trying to do, and oftentimes it's kind of overlooked as an underwriting tool, but everything revolves around the application, and that's pretty much it as far as what the underwriter has to try and figure out, is this a 5A or 4A or a 3A? And there's a lot of info on that app that they look at: number of employees, you look at income. Does it make sense that this person gets a 6A based on all those things? So paint the picture, as you said. Give us more info is better.
Perfect. And I know we're running up on our time here. You can see again when I nerd out on the
Yeah,
underwriting
it's easy to
side.
do.
But from financial, I think the one thing you're looking at, income income consistency. Obviously, underwriting a business owner versus W-2. I think that's probably your biggest thing where I see people, have the issue. What are you looking for from a business owner?
Yeah.
How do you determine their income? And then obviously you have phantom income where people are writing stuff off that, depreciation and things. So what in a short piece, how do you look at income and consistency?
Yeah, I'll try and kind of encompass all that and as quickly as I can, and I struggle with that sometimes. But basically, yes, we underwrite a lot of business owners. I mean, it's by nature, small business owners. They don't have access to group LTD. It's a natural sale. And the two things I would say that a producer should keep in mind are, number one, when we're considering net insurable income. So there's two components to that for a small business owner in particular. What do they pay themselves via W-2 or partnership distribution, plus the business profit or minus the business loss? It's the total of those two things that gets you the net insurable income. Taking it a step further, what underwriters often see, especially the information on the app, is people put on there the top line revenue figure for a business owner's business profit or loss. I don't care about the revenue. The plumbing business brought in, $1.5 million. The amount we're going to insure is the 1.5 minus all the customary business expenses as defined and demonstrated on the tax return. Give me the bottom line profit number. There's that. Now, if they had a W-2 in addition to that, add the two together, that's your insurable income. And that's what most people, they don't realize there's two components. And then we have a real problem with folks giving us the revenue and not the net income or profit number. And with business owners or anyone, we are looking for income consistency. We ask for 3 years of data on our application for a reason. Not such a big deal if you're a home office employee of an insurance company. It's probably going to be pretty stable, probably going up every year with merit increases. But anyone on a variable comp structure or a business owner, there can be some volatility there. And if we see, if the trend line is down, that's worrying as an underwriter. Why is your income going down year over year? We may say we're taking the lowest number. If it's kind of one of these deals up and down, then we may look at an average income just to kind of mitigate the risk that we're overinsuring someone, which can be a real problem if someone that's got too much coverage relative to their income goes on claim.
Okay. Yeah. I mean, again, I think, when we put all these pieces together, it really speaks to the value of a pre-screen, the value of potentially, if there are things discussed, a cover letter. My comment, when I would do presentations to the agents, I always say, underwriters are like kindergartners. And if you give them a blank piece of paper, and let them draw a picture, their parents might think my child has the best artwork. Other people might look at the artwork and think your child's disturbed.
Yeah, that's true.
So,
yeah.
I said, but if we give them if we give them paint by numbers, and if you have 100 numbers and they connect 95 of the 100, it's going to look like your client pretty much. So I kind of say that in jest, but let's work together. And what the goal is, I would say the toughest thing is to get somebody to talk to you as an agent. The next hardest thing is to take an application, and then it's our job, to potentially get that out and have it look like what you've submitted. And I think that's, when working as a partnership, that's what I like to see. So I guess any additional tips, as before we close this out, to a successful experience? Or
I think what you said just kind of hits the nail on the head. Field underwriting, as it used to be called, is kind of fallen by the wayside a lot, and that's a real shame, because I think the process you outline, I have the utmost respect for producers and the difficulty of the job of trying to talk to someone, convince them to buy, convince them to take an application, and then something bad happens during underwriting. So the way I would approach it, and I'm not a salesperson, but it is about the pre-screening and the field underwriting. Get to know your client, trying to identify what potential problems there are, and set the table on the front end for what might happen. If you uncover some medical history, get it pre-screened so you can tell the client, this is typically what someone with your history, what the outcome may be, exclusion rider rating, be that whatever it is. And then then you have to roll your sleeves up and convince them, here's the likely outcome, and get them to accept that. That's a lot easier than waiting till the end of the underwriting and finding out the 5A is a 2A, or the age 65 benefit period is now a 5-year benefit period with a rating and an exclusion for ulcerative colitis or something. So really, work done on the front end is going to make everyone's life a little bit easier in terms of getting a policy successfully placed. And at the end of the day, and that's what every underwriter wants. We don't make any money on a piece of business we decline. Our job is to get business on the books that is mutually beneficial to the producer, the client, and the company. So, and I know that's something you do, Brady, in your organization. I love to hear that you're encouraging pre-screening, you're encouraging cover letters. Those are all the things that that help that mutual goal of getting a policy placed, and we don't see enough of it. So anything you can do and producers can do, whether it's a cover letter, pre-screening, all of the above, it's just great to hear.
Well, that's good, Paul. Again, and I appreciate your time today. We view it as a partnership with all our carriers. No one wants to put bad business on the books. There's only a handful of disability companies, and you don't want any of them to go out, because that means your selection's a lot less. And, the other part, when you develop, those relationships with your underwriter, again, sometimes on the tough cases, and you can put it in, it's like, okay, we know you're a partner, you're trying to work with us. And sometimes you get the benefit of the doubt on some cases. And that's, I don't care what product and what company you're working with. It's, if you come in and you're doing the right things and they see clean business, you're more apt to work with them.
Yep. I agree.
So, all right. Well, again, as we wrap up, I'd like to remind you that today's brew and our entire library are recorded and shared on the brew page on our website, www.e4.insurance. Don't forget to subscribe to our YouTube channel to keep up with all brewcasts. They're released every Wednesday. Next week, we will continue May's lineup on disability income awareness. I will have a special guest from North Risk Partner discussing guarantee issue and how he's put it into practice. Thanks everyone, and thanks Paul. And we will see you next week on the brew.
Thank you.